We frequently get asked by buyers and sellers of businesses and interests in businesses to help them figure out what type of investment they should make to meet their risk and return profile. So on an individual basis, we often think about risk and return in spending our dollars. So on one end of the spectrum, I might buy a risk-free Treasury bond that gives me a low return but is also very safe. On the other hand, I might spend my money on a lottery ticket. High return potential, but also very high risk that it doesn't pay out. What we do on an individual basis all the time also happens at a corporate level. We have various types of financial instruments that we can use to optimize either a seller's objective in raising funds and giving up only a portion of their business. On the buyer's side, having an investment that really meets the risk and return appetite of the organization as a whole. At the lowest end of the spectrum might be a very traditional loan that pays a fixed interest rate. From there, we can add incentives that might also increase the risk profile. The other extreme of this would be an option to buy common stock. What we see most frequently in the private equity space is that different types of investors will find their optimal range of investments that they want to make, often on the lower end in the form of convertible debt or preferred stock that has preference over common shareholders, but may also be convertible into common should the performance of the company meet certain targets.